Hi folks, and welcome back to Meaningful Money. Today, again, we're talking about classic investor mistakes and how to avoid them. Okay, I've got 3 more classic investing mistakes for you this week, and of course, how not to make them. The 4th investor mistake, we dealt with 3 last week, is watching your portfolio too closely. Now that might seem counterintuitive. Surely you should keep an eye on your investments. And yes, you should, but not 3 times a day. Most of us investing in funds, the price only changes once a day anyway, so what's the point? How do you avoid the temptation to check your portfolio too much? The answer is to commit to not doing that and instead realize, well, you're not going to do anything anyway. There's no point. Just checking it for interest is pointless, really, and can lead to anxiety if you see the value going up or down too much. Well, not up, that's good, right? But certainly if you see it going down, that can lead to unnecessary anxiety. There's no point in looking at a very short time window when it comes to a long-term investing. So commit, decide, and stick to only checking your portfolio maybe once a month. Even better, once a quarter. Write down the value of it, stick it in a spreadsheet, and then forget about it for another month or another 3 months. Remember, if you've invested in a broad spread of investments, as I always tell you to do, then you should give that time to work. Investing is, after all, for the long term, so why worry about the short term? The 5th classic investor mistake is paying too much in fees and in tax. There is no greater drag on investment performance than excess charges and unnecessary tax. So we've got all kinds of fees: trading fees, platform fees, annual management charges on funds you choose, advisor fees. You know, it all adds layers of cost which can really drag your performance back. Then there's tax. Nothing worse than paying unnecessary tax to hamstring your investment performance. So what should you do to avoid paying too much charges and paying too much tax? The first thing is to discern the difference between cost and value. Any advisor, for example, and this is where I justify myself a little bit, should easily outweigh what they have charged you in value they have given to you. Maybe they have saved you tax, maybe they have saved you money in other ways. They should be able to justify their value by saving you more money, more time, more effort, more hassle, more anxiety, or whatever. So cost is one thing and value is another. But if you do want to reduce costs, look at each level. Maybe you're on a platform which is costing twice as much as this one over here. Maybe you're invested in expensive funds when you could consider a cheaper, more passive alternative. And when it comes to tax, it's simply about planning ahead, thinking about what your tax situation might be and taking steps to reduce it. Using ISAs, using pensions, using all the reliefs and allowances available to you. That's just good investment planning. Don't be passive and hands off and then say, I've got a tax bill to pay. Instead, think ahead and plan for it. Keep your costs down and keep your tax under control. And then number 6 on our list of 9 classic investing mistakes is thinking you know what you're doing. Take it from me right now, and I'm going to pull no punches. You probably have no idea what you're doing when it comes to investing. Now, some of you immediately, I've got your back up. You say, well, I've got an economics degree. I read the Financial Times. I do have an idea what I'm doing. You probably don't, let's face it. You maybe have made some lucky calls, got lucky with timing, and suddenly you think you're a star fund manager. But I'm telling you this, unless you're on the ground in the city, unless you are doing this full time, unless you understand things like market latency and high frequency trading and the impact all that stuff has on the world, unless you understand geopolitical risks, unless you understand the possible outcome of an EU referendum or whatever, unless you can understand, compute, and pass all that stuff and make an investment decision on the back of it, then you have no idea what you're doing. I have no idea what I'm doing. To a certain extent, those in London doing this full time only have a slightly better idea what they're doing than we do. But at least they've got structures, processes for doing it, whereas you are probably doing it on your own. Investing is a science, it's not an art. The world is changing every day. You are almost certainly not going to be able to keep up with it. So how do you avoid making the mistake of thinking that you know what you're doing? I would opt for passive investments. It takes all the work out of investing. Put a good structure together, broad, multi-asset, spread around the world, and let it do its thing. Relax have a bath and a glass of wine and chill out and enjoy the process. So, 3 more investing mistakes there. Watching your portfolio too closely, paying too much in fees and tax, and thinking you know what you're doing. Sorry, you really don't. 3 more next week, so stay tuned for that. And until then, thanks for watching.